Go. Hey, everybody, Economic Ninja here. I hope you are doing well. Today is an awesome day. Why? Because I've been telling you about precious metals and they're going to start to catch up with inflation. And is it happening now? We don't know. But on a day where gold is up, I have got David Garofalo from Gold Royalty Corp. And I actually want to talk about why gold is finally starting to bump right now. David, how are you doing?
I'm well. Thanks for having me on.
Yeah, thank you so much for coming on. So it's interesting because I've been talking about precious metals and how they are slow to the party using the 1970s as an example. And you and I were talking before the interview, and you said you have vivid memories of the gas fuel crisis and when gold blew off in 1980. Can you talk about that a little bit?
Yeah, I mean, that was the last big inflationary cycle, and I see a lot of similarities to what we're experiencing now. And what happened then is we went through an oil-led crisis. You know, our economy was largely run on oil, and oil infected the supply chain and actually impeded the supply chain. So we saw supply chain disruptions at the time, lining up for fuel, shelves that were empty. We're seeing that now. I mean, the disruption is not necessarily led by oil today, but it's led by monetary expansion. And the interesting thing is we got a new Federal Reserve chair in 1979, Paul Volcker, who was a hawk on inflation. And he, like the current Federal Reserve chair, talked about tightening, bringing up nominal rates. But of course, by that point, inflation was galloping out of control. It took years for Paul Volcker to tame inflation. He did it, but it took him a long time. Gold did not peak when Paul Volcker started raising interest rates. Gold peaked several years after he started raising interest rates and started to tame inflation. At that point, gold achieved an all-time high of $850 an ounce. That's actually the real all-time high in gold, because if you inflation adjust that to today's dollars, that's $3,000 an ounce. We're nowhere close to the cyclical high for gold.
You know what? I completely agree with you. Not a lot of people look at inflation adjusted terms. They're looking at dollar terms. What they don't realize is that dollar is losing value. So let's talk about Paul Volcker, because he was hailed as a hero, but nobody wants to talk about what happened to the real estate market when he spiked those prices. And the truth is, real estate came down. Now, in your opinion, do you think our current Fed chair has the same ability to just raise prices like that?
No, because we're also dealing with a fiscal crisis. We have massive amounts of debt that's been strapped on, not just in the US, but globally on a coordinated basis. And that's not a recent phenomenon. It really goes back to the credit crisis we experienced about a dozen years ago, when we were on the brink of financial ruins. Our financial institutions were about to collapse. And there was a massive reinflation trade that happened on a global coordinated basis across the world, with all the central banks cooperating with each other. That was unprecedented. And guess what? It didn't stop when we exited that credit crisis. Monetary expansion continued unabated for the last dozen years. So we've introduced all sorts of excess into the system. We're seeing valuations in the equity markets stretch beyond recognition. We're seeing things like Bitcoin inflate to ridiculous levels. You know, we're seeing a lot of excesses in the system, a lot of red flags, and there will be a severe correction in the marketplace. And I think ultimately that'll lead capital back into the ultimate currency. The only one with physical properties has been recognized as a currency for 4 millennia, and that's gold.
You know, I'm glad you brought up all of the fiscal changes that financial changes that happened around the world, especially around that Great Recession. And the reason why is because I look at these numbers, like we just hit inflation numbers we haven't seen in 40 years. But what's happening is since the Great Recession, we started having those, the vast drop in the Fed funds rate. But then when they started to raise, they would raise at these small increments, like a quarter a point. In March, it's being announced that they're looking to raise the interest rate, the Fed rate, a half a point. What's really interesting to me is that's the highest, the most aggressive raise in one whack in 20 years. So now all of a sudden they're going to do this. What do you think the market may react like when that half a point in one session gets slammed on the markets?
Look, I think they're already pricing that in, frankly, but I think it's irrelevant. And I'll tell you why it's irrelevant, because inflation is not 7%. If you're putting food in your stomach, fuel in your car, or putting a roof over your head, we're far into double-digit territory in inflation.
Oh, yeah.
That means real interest rates are decidedly negative. You put your money into a savings account, which yields effectively zero. Maybe it's going to be 0.5% in a few months. Well, if you have inflation at 10, 11, 12, even 20%, your capital is eroding by 20% a year. And that's the reality. So it doesn't matter what they do with nominal rates. A quarter point here, a quarter point there. Interest rates on a real basis will continue to go deeply into negative territory because inflation is galloping now, and it's only going to go up for the foreseeable future. It'll be years before nominal tightening and interest rates has any sort of impact or restraining impact on inflation.
See, and I'm glad you brought that up because so many people are playing the short game and I'm always trying to play the long game. And a lot of people are saying, because they know the ninja's been into cryptocurrencies for a long time and they go, why are you worrying or talking about precious metals when you're making so much in crypto? And I said, because I've already made so much in crypto. I'm already looking at something that nobody else wants. And right now, well, actually not in the last year or two, but that's precious metals. And I say in the last year or two, because so many people have woken up to what's going on with the Fed, what's going on around the globe, and understanding there's only so much of this resource, gold and silver. You know, you could put platinum and palladium into that and rhodium, but really gold and silver as far as monetary metals. Now, I love that you brought up the point that Paul Volcker, when he started to raise rates, gold and silver didn't react. They were trickling up, but they didn't really make that moonshot until panic set in. And a lot of people don't get that. When rates go up, people go, well, that means it brings value to the dollar. However, not during a crisis. When a crisis is happening and you have inflation like the 70s, now you have rates going up, you have everything going up. There's now this fear that moves into the markets, right? That where they go, oh, there's something wrong with the dollar, so we need to flee into something outside of the dollar. Would you agree?
Yeah, absolutely. And you know, commodities don't go up in a straight, steady line. When there's a reaction in the marketplace, when there's that panic, as you correctly characterized it, there's a massive flight of capital. And I can give you a really recent relevant example in the commodity space. Yeah. Copper prices a year and a half ago were near all-time lows on a real basis, about $2 a pound. Then the world started to realize, you know what, we need copper to decarbonize our economy. Everybody's talking about climate change and the need to go into electric vehicles. And guess what? Electric vehicles use 3 times the amount of copper that a regular vehicle used. Copper went from a low to an all-time high seemingly overnight because there's that flight of capital, that realization of the market. When sentiment turns, it doesn't turn gradually, it turns dramatically, drastically, violently. And that's what's going to happen to the gold price, in my view.
Well, I completely agree. And right now we're sitting on a really nice gold price around what, $1,850 somewhere, give or take, when this video comes out. But you know, what's interesting is we're getting close to the all-time high in gold. Yet when that was achieved back in what, 2010, and I'm talking dollar terms, not inflation adjusted, we didn't have this much debt or this much crisis. And we also now have the world's largest company last year saying, we're buying gold. Tesla changes their rules of saying, we are not only going to be able to buy paper gold, you know, shares, have it stored somewhere. We're actually allowing our company to buy physical gold and bring it in because they don't trust the government. So let's spin into what you do in your company, because I've talked to my subscribers about what a royalty company is, and you run Gold Royalty Corp. I do not personally own this company, but you just made some big news today. And when we're talking negative rates and how little you make in a savings account, I want you to talk about what your company does, but what the big news is in relations to your savings accounts.
Well, look, let's talk about gold as an asset class, investing, and how to best invest in that to get the maximum leverage to a rising gold price. And
perfect.
So if you think gold is going to $3,000 an ounce, if you buy into our thesis, I think the question you have to ask yourself is, how do you best play it? And you can buy gold physically. That's easy enough to do. Line up at a bank. Of course, you have to find a place to store it, and the security concerns and whatnot, and there's storage costs associated with that. You can also buy an ETF. There's the GLD on the New York Stock Exchange that's physically backed by gold. That's another way to play gold, and you get the economies of scale on your storage costs.
We all have our conspiracy theories, just so you know.
Yeah, no, fair enough, and I understand that, but
because you're doing something totally different than that, so I had to throw that in there.
That is an available investment. So you're
totally. I agree.
I have to say the ETF has opened up gold to a universe of investors institutionally that couldn't own physical commodities before.
You're 100% correct. Yes.
Funds, mutual funds, they can own the commodity now. They couldn't own it before without the ETF. So it's been helpful for the industry.
Yes, it has. You're absolutely right. Absolutely right.
And the other way to play it is buy mining equities, you know, the producers, the ones that produce the gold, dig it out of the ground, explore for it. And the advantage of that, of course, is you get leverage in terms of their profitabilities. The gold price goes up X%, you're going to get X+% increase in profitability.
Yep.
The problem, of course, is their cost structures are dynamic.
Yes.
And they're not static. And we're in an inflationary cycle, and they're experiencing inflation like everybody else.
Yeah.
And if you look back 10 years ago, after we came out of the credit crisis, it's instructive because gold went up 140% at the time.
Yes.
And what happened to the mining equities is they actually significantly underperformed the commodity. They were only up 66%. And the reason that was is because exiting that credit crisis, we were in the middle of the Chinese super cycle. Base metal prices were strong, gold prices were strong, and the producers, both on the base and precious side, were building new mines left, right, and center. And that drove up input costs. Yep. Even though inflation in the general economy was 1-2%, was quite muted. And so that undermined margins dramatically, even as the gold price went up. So the mining equities underperformed. Interestingly, the streamers, the royalty companies, they actually significantly outperformed the commodity. They were up about 350% against 140% increase in the gold price. You know why? Because royalty companies take a percentage of the top line, they get a percentage of the revenue, but they're completely insulated from the operating costs. And they also get leverage to exploration. So if the operators who are operating those mines find more ounces in the ground through their exploration efforts, we get a royalty on that as well.
Yeah. So let me just try and really bring this down to a baseline for people that are brand new to this. A royalty company essentially comes into with an agreement with a mining company that wants to raise money. And they say, hey, you want to raise money? Cool. Let's look at your assets. And then we say, well, you got some metal in the ground. You got, great equipment. How's this? We're going to lock in the metal price, the gold price at this price. We're going to buy it from you. If I have this right, for so long or for so many tons. And so we're going to give you that money up ahead. So as you're mining it, you have to give us back our gold at that price. And they negotiate a much lower price than what you see on the New York Stock Exchange or, any of the spot prices. Is that correct?
Typically a fraction of what the current gold price is, because you're providing that upfront capital. The other model, of course, that's a sister to streaming is royalties. So rather than taking physical gold back, you get a percentage of the revenue, typically 1 to 3% of the top line. It's a similar concept, so you're getting a fixed percentage. So as the gold price goes up, as a royalty and streaming company, you're getting increasing revenue as well. And so that's another way. It's called royalty and or streaming. You describe a streaming model, and royalty is the other model, but it's essentially the same thing. And many royalty companies do both. They both stream the physical commodity and or take a percentage of the revenue.
Do you do both?
We do both, and we're open to doing both. And many of the royalty companies do that. And it's 6 of one, half a dozen of another. In other words, you're fixing your gold at a fixed cost. It never goes up. So you're insulated from operating and capital cost inflation, which is the beauty of this model. And why typically it tends to outperform the mining producers in an inflationary environment like we're currently experiencing. So I think history is going to repeat itself. We're going to see a repeat of what we had 10 years ago. When we had inflation in input and operating costs, I think the royalty and streaming companies will significantly outperform. That's why after 32 years of building and operating mines, that's what I've done my entire career.
Yeah.
I've switched gears and I've really become a royalty and streaming CEO to focus on financing mine development construction, which needs to happen because there's been severe underinvestment in the mining industry over the last half a dozen years or so.
Okay. So this brings me to my next question. And what I wanted to get to, I was jumping the gun in the beginning when we started talking about your company, because I'm really excited about the news. Because again, guys, I don't own this company, but they're doing something they just announced that's unlike most royalty companies. And so I'm going to let you I want to say it. You just announced a dividend. Sorry, no editing. David, you just announced a dividend. And what's really interesting is your dividend right now is beating people's savings account interest rate. So let's talk about that, because I'm not joking. Like, I get excited about this because many people speculate in stocks is all they're doing is speculating that you buy it at one price and you sell it at a higher price, right? Wealthy people look at dividend plays. Dividends are very important, and it's very important for a company to give back to its investors because it retains investors longer term, the bigger vision. And so I'm sorry, I'm going off, but I'm not joking when I say I get excited about dividend plays, and I've not been able to interview the head of a company that's giving a dividend, let alone just announced one. So talk about that.
Sure. Well, our inaugural dividend was announced earlier this week. It's a penny per quarter for every 3 months, and that equates to just under 1% yield. And so you're correct. It's well above what you're getting in your savings rate, savings accounts. And what's remarkable about it is we only IPO'd 9 months ago. In March of last year, we IPO'd our company. We raised $90 million US on the New York Stock Exchange under the trading symbol GROY, GROY. And since then, we've increased the size of our company tenfold in terms of our royalty portfolio. We started out with a modest royalty portfolio of 17 royalties. And through the acquisition of 3 of our peer companies, we've been active on the M&A side. We've gone from 17 royalties to 191 royalties.
Wow.
And we have 6 that are in production currently. They're generating strong cash flow. We have 7 in construction, which represents a significant upward trajectory in our cash flow over the next 3 to 5 years. And then we have 180 odd royalties that provide us a pipeline of growth for the foreseeable future. So effectively, we have an annuity now. Yeah. And so it behooves us to share that annuity with our shareholders. We've already built up sustainable and growing cash flow. We've announced an initial dividend that we think we can grow over time as our cash flow grows.
Exactly. So now I love to tell my subscribers, when I invest in stocks, I love to take a little chunk. If I'm looking at something, I like to take a little bit, right? Don't dive right in, right? Because the facts are, especially with the dividend play, that percentage you're talking about is based on today's share price. And that could change tomorrow. If the stock goes up, the percentage goes down. All right. Because the dividend right now stays the same. However, if you, let's say you nibble on something, and again, I don't own this, I'm not a financial advisor, but I'm an investor. If you nibble on it and you're looking at the team and you like it, and like David's saying, that's just an initial, if they're already showing the faith that like, we want to be a dividend, because we understand as you pay more dividends, people buy your stock and hold it, which brings value to the stock, which makes the company worth more. And that's what David wants, right? Because he wants his shares to go up as well. That's human nature. That's how you know you have something sort of good, right? But there's a lot of things to look at. Sorry, I'm long-winded. But let's say gold takes a dump and the market sells off and your shares go down. Now you go, well, now that dividend is a higher percentage. And so that's something that happened in 2008 and 2009 that people didn't pay attention to. Since the stocks sold off all over the world, those dividend plays became extremely powerful. I was watching yearly dividends being paid out between 10 and 14% based off of that share price. So with that being said, again, David, can you just go over before, because I don't want to go too long in the interview, but your dividends based on the producing projects you have, but like you said, you have 190 royalties going on, and as those are in construction and start coming into production, you're going to have more income, and it sounds like you're going to look to increase that dividend over time, right?
That's certainly the objective. We're confident that what we've established as an initial dividend is sustainable for a long time, and has the prospect to grow dramatically as our cash flow starts to pick up, given all the construction stage projects that we have, which will contribute cash flow over the next 3 to 5 years and beyond. And then all those other royalties that are in various stages of development, for early stage exploration through to feasibility study, that provide organic growth. We don't need to issue any more stock. We don't need to buy anything else. We have growth that I think will serve our shareholders well for many years to come.
That is awesome. I'm looking at your chart right now and taking a look at the market cap. It looks like we're sitting around, what, 648 million? That sound right?
That's correct.
Yeah. And it's amazing to me because, you know, some people, like, I love micro cap stocks, but this is not a mining stock. This is a royalty play. And this is a lot bigger because it's easy to say that these companies, as gold increases, and there are some people out there that say gold's going to, 5,000, 10,000, even, what was it, Jim Rickards calling for 50,000, or so there's a few people. My point being is that you can see these in the tens of billions of dollars someday. And I'm not saying that gold royalty is going to that. Okay. But I'm just telling you, this is the stuff that I remember investing in Bitcoin and saying, yeah, it's going to 10 grand, it's going to 50 grand, and people just laughing. Well, now I'm talking about precious metals. I'm already past that stuff and I'm looking at the next plays. So look, I don't want to run this long. And David, I really appreciate your time and helping out with the channel and all of that stuff. Like, it's true blessing to meet you guys, have you helping out everything that Ninja Nation's doing. Is there anything you'd like to close with?
Well, the one thing I want to leave in people's minds is I have 6 employees to run a almost $700 million market cap company. And I could run a company 10 times the size with the same number of employees. It's an eminently scalable business. Our costs are small and fixed. That means every dollar of additional royalty revenue we add goes right to the bottom line, which gives us the capacity to pay more dividends over time. So we've built an annuity.
And I got to add to that too.
That annuity with our shareholders.
That's great that you said that, because there are so many people that look at how big is the company, how many employees and stuff. And first off, that's all overhead. You are a contract-based company. I mean, there are hedge funds that make billions and billions of dollars, and it's a handful of guys. And they sub out, they contract out, but it's contracts. That's what you work on. And I want people to understand this is not a mining company. There's not picks and shovels. These are contracts that are being set up. And I love that stuff. So I really appreciate you coming on.
I really enjoyed being on. Thank you for having me on today.
Absolutely. And what I'm going to do is I'm going to drop in the comment section a special link whatever you guys want to send me as far as a news or something like that, but we're going to get something in the comment section pinned so that if you guys want some more information on Gold Royalty Corp, you guys can jump right to it. All right.
Well, we're on goldroyalty.com. Easy to remember.
Perfect. Goldroyalty.com, guys. And with that being said, I thank you so much. The Economic Ninja is out.